The Senate Banking Committee passed the Digital Asset Clarity Act 15-9. This isn't just one law. It's the official signal that the decade-long Wild West era for crypto is finally over. Bottom line, this bill ends the SEC's era of regulation by enforcement. It's a wide-open highway for trillions in institutional money to flow in legally. Now let me explain why I'm so confident and break down the facts that will reshape the market, one by one. The biggest headache for crypto investors has been not knowing if their coins are commodities or securities. But this new bill finally sets clear rules, creating 3 categories based on decentralization. Now, assets like Bitcoin and Ethereum are digital commodities under the CFTC, while those with centralized roots are tokenized securities managed by the SEC. So what happens once these categories are clearly defined? First, it enables portfolio cross-margining, letting institutions use stocks, derivatives, and crypto as collateral in a single account. Basically, it means big investors can manage their capital way more efficiently, acting as a massive trigger for hedge funds and major trading firms to flood the market with liquidity. In fact, global firms like Standard Chartered and Bernstein are pointing to this regulatory clarity, predicting Bitcoin will hit $150,000 by late 2026. It's basically reached a point where big institutional money, which was hesitant due to uncertainty, really has no choice but to start flowing into the market. If the institutional money I mentioned builds the market's foundation, then RWA, real-world asset tokenization, will be the engine that scales this market's size by dozens of times. Section 505 of this new bill applies the same regulatory framework as traditional securities, giving these assets official legitimacy. This matters because it's a strategic move by the U.S. to maintain dollar dominance through the world of crypto. Look, BRICS nations are pushing for de-dollarization to pressure the U.S., but America's firing back by expanding synthetic dollars on-chain. By getting stablecoin issuers to buy massive amounts of treasuries, they're essentially building a giant pump to pull global cash back into the U.S. economy. Experts think this RWA market could hit $2 trillion by 2030. This scale is over twice the U.S. defense budget. It's massive. Now, titans like the NYSE and DTCC have the green light to jump into this market. Ultimately, only the investors who grasp this shift will lead the charge in this $2 trillion market. So with these massive shifts, you're probably wondering, what's the deal with DeFi and interest income? Politicians once tried to ban stablecoin interest due to bank run fears, but the Tillis-Alsobrooks compromise found a really smart fix. They've banned simple interest on deposits, but rewards for providing liquidity or securing the network. Those are now officially recognized as legal income. Basically, this signals the start of legal mining within a clear regulatory framework. Since node operators and oracles now have a safe harbor from criminal liability, the legal risks for DeFi are gone. This allows institutional investors to run delta-neutral strategies on-chain, seeking steady returns regardless of market volatility. Now, this might all sound a bit too rosy, and there are definitely counter-arguments. The biggest worry is the political uncertainty that the bill stalls and misses the 2026 midterms. Plus, some centralized Layer 1s might face a painful restructuring just to meet the SEC's strict security standards. But listen closely, everyone. We need to focus on the fact that this Senate committee vote passed 15-9 with bipartisan support. This tells us crypto regulation isn't just a political football anymore. There's a real consensus that it's the necessary path for our national interest. Now, some altcoins might fail to adapt and drop out during the grace period, but for the market overall, think of it as trimming the fat to build lean muscle. It's how we get a healthier, stronger market. Now, let's dive into some specific assets to watch. First, Bitcoin and Ethereum are almost certain to be classified as digital commodities, making them top picks for sovereign wealth funds and 401k portfolios. Next is Ripple. This bill will likely end the long-standing debate over its security status, and a spot ETF approval could bring in up to $8 billion in fresh capital. Solana and Chainlink are also top candidates for big institutional funds like Grayscale. They're moving beyond hype to become real financial infrastructure, setting the stage for a total structural re-rating. Let's wrap things up. This Senate bill is a historic shift, moving crypto from speculation to a core mainstream asset. The U.S. is using digital assets to boost dollar dominance, and will soon see RWA and DeFi markets experience unprecedented, explosive growth. The gap between patient investors and everyone else is about to get massive. Now that you see where the market's heading, all that's left is to jump in and follow the flow. Hope today's video gave you more confidence in your investments. Like and subscribe, and I'm Ray, helping your money work for you.